Explain to us this something that we can't seem to reconcile. You know, the balance sheet is going to start the unwind, but traders are not sure which way yields are going to go.
Yeah, it's really interesting because quantitative easing is this, bond buying system, and you would think that when the Fed comes in and buys, a ton of these treasuries, that yields would fall. But in fact, during periods of QE, yields have gone up. So the question is now that they're beginning their unwind and actually reducing QE, most people are expecting yields to go up, whereas some are arguing actually they might be able to fall.
Yeah, in fact, we're looking at this wonderful chart which shows QE versus the 10-year yield, and in past periods of QE in the purple, traders were anticipating one thing and yields did another, right?
Yeah, you can sort of see right after periods where the QE actually stops, you can see that the yield is falling on the 10-year Treasury. So, this is sort of a period where the QE is going to be reduced and the unwind is happening. And so the question is it possible for yields to actually fall or stay where they are, even though the Fed is actually pulling back and the private market is going to actually need to absorb more of the Treasury market?
I suppose it is possible, Brian, because the economy is showing few signs of returning to sort of pre-crisis growth levels.
Yeah, that's the other thing that's really interesting is the Fed is tightening at a time when inflation is still below their 2% target, and real GDP is projected to be 2.2% this year, which is fine, but it's not anything to, write home about. So people are trying to reconcile where can we get this higher yield forecast that so many people on Wall Street have been calling for all year. There's not a lot of reasons to point to it. Some have pointed to this unwind, but then again, that's just a form of tightening in the face of, subdued growth, which isn't exactly a recipe for higher yields.